Hi, I'm Mike Ward. I want to talk to you briefly about the relationship between risk and return. I'm going to show you a bit of history and we're going to look at some ways of reducing risk. So, to start with, these are the questions that we're going to try and answer in this particular session. How can you earn a return with zero risk? Is that possible? What is the market risk premium? And can you reduce risk in an equity investment, and how is that possible? And then if we get a chance, we're going to also talk about the Sharpe ratio. So I thought I'd start off by showing you this very interesting history of 10-year US government bond yields. So the blue line here represents the 10-year yield, and you will observe that it peaked over here in about the early 80s and somewhere around about 18%. Most people have forgotten that. And the cause of that was the very high oil price that we had, an oil crisis back then, and there were great concerns about inflation. But you'll observe that that rate has steadily come down over the last, 30 years, and it's dropped, in fact, by about 15%. Now, the dark blue line over here that you're seeing at the bottom here is actually the US federal funds rate. And so this is what we would call the repo rate in South Africa. It's the rate at which the Reserve Bank sets the short-term end of the yield curve. And you'll notice something very interesting happening down here. This is what happened when a certain bank, if it had been Lehman Sisters, I think this would not have happened. The world would be a more safe place, let's put it that way. And the Federal Reserve Bank ramped down interest rates in the US to try and stimulate the market, and ever since then they've been kept at zero. So we've had some interesting times. Now, I wanted to show you this too. This came out about a month ago, and this is the 30-year yield that we're looking at over here. And what you can observe at the end here is that it dipped to 1%. It had never done that before, ever. And in fact, the 10-year yield also, for the first time ever, dropped below 1%. So this is a sign of very turbulent worries in the market. And this is a slide from today, in fact. And it talks about the fact that inflation expectations are tumbling down. And this is because the fear in the market is that this COVID virus is going to now cause a stagnation. People will stop spending money and we're in trouble again. So this is interesting stuff. Just to show you how interesting it is, I found a couple of slides, and these go back a bit. This is actually 2016. And Henkel and Sanofi, who are public companies, issued bonds at negative yields. Now, we know governments have been doing that for a while, but how interesting that public companies were able to sell their own bonds, corporate bonds, to investors, and the investors gave them the money, and every 6 months investors pay the companies coupons. I mean, this is just a crazy world that we're living in. I think this is my favorite example here. These apartments here that you can see in the background in Copenhagen, in Denmark, they were bought by a couple of investors. And what happened was they went to the bank and took out a big mortgage. They bought these two apartments, and they rented out these apartments to tenants. And every month what happens is they collect the rent from the tenants, and every month the bank sends them interest. I mean, how crazy is that? That seems a very easy way to make money. So this is the kind of world we've been living in. Now, 2 years ago, the IMF was warning about the huge debt pile, $164 trillion. I mean, we don't even know how many zeros there are in a trillion. So, I mean, what's happened is that because interest rates have been low, people have been borrowing more, and companies have been borrowing more, and governments have been borrowing more. And so you can see that global debt levels have been ramping up. They're not as bad as they were if you measured them as a percentage of GDP, that's true, as they were in war times, but they have been going up and up and up. Now, this is just a crazy equilibrium. I like John Plender. He writes in the FT some excellent stuff here. And he's talking about the fact that this high debt, low rate bond equilibrium cannot last forever. And he was writing this a year ago. He says it's a scenario that until recently would have struck most observers as downright implausible. Financial cycle in which global debt piles up inexorably while nominal interest rates collapse. You know, and I know, that when you go to the bank and you borrow more and more and more money, you don't get a cheaper interest rate. The interest rate goes the other way. How long can this last, he says? This just is a crazy system. Well, we're going to see it's going to last a lot longer, because we're now living in a world where, in fact, direct cash handouts are going to come. We can see the US is talking about that. And other countries are talking about this. The FT's been singing its praises yesterday. The front page was full of this. So we're going to give consumers money. Where does this money come from? It's going to come from central banks, and they're just going to create it. And so it's a very strange world that we are living in at the moment. I'm going back in time to look at sort of old-fashioned stuff. And what I'm showing you here is actually quite a famous chart. It just looks at the data between 1926 and 1996. And it's looking at US data. So these are dollars that we're looking at here. And what you can see here is if you'd invested $1 into inflation, it would have been $8.85. In other words, what used to cost $1 would, in 1996, have cost you nearly $9 to buy the same thing. If you lent your money to the government, short term or long term, you would have had either $13 or $33. Your $1 would have been worth that. If you had invested your money into large company stocks over here, your $1 would have been worth $1,370. And if you'd invested it in small companies, we call this the size effect, small size effect, it would have been worth even more, according to this chart. Now, that kind of makes it look obvious that you should invest in shares. Well, I think it is actually, but what you can't see from this chart is because this scale here is a log scale. So you look at this little dip over here that you can see in small company stocks here. You probably won't remember that, but I remember that crash because it affected me. I lost my job because of that crash some years ago in the 80s. So we need to look at the risk as well as the returns. And to measure risk, we are going to use standard deviations. And if you look at this plot here of the standard deviations over that same time period, you observe that if you had lent your money to the government here, you have relatively little risk, almost no chance of it going down or not much down. Whereas if you put it into small shares, you might have lost 80% in 1 year. And there might have been other years where you made back 80%. So it's much more volatile. And that, in a sense, is how what we tend to use as risk. But maybe that's not a good measure, because I'm showing you here, for example, if you'd invested your money in the Johannesburg Stock Exchange, and this is the all-share index here, and we're looking at total returns, including dividends. If you look back over 1 year, you'd get this blue line, and you'd be saying, oh, wow, I did well, I made 110% last year. And then a couple of years later, you'd say, boy, I lost 20%. Oh, I made money. Oh, I lost money. You're going to get pretty giddy. If you rather focused on how well you did over 20 years, you get this red line over here. And you can see this red line just tracks along pretty much at 20%. Okay, it's come down a little bit at the end here. It's more like 18%. But the thing is, you don't want to get too nervous taking short-term views on markets. In fact, we know if the market crashes, you should be buying shares. Right now, emerging market shares are crazily cheap. So, you've seen this chart already, and I'm just reminding you that here, looking at the JSE, if you looked at the total returns on shares, you'd have had about a 16% return. If you'd invested it in bonds over this time frame, you would have had a much steadier, notice this is much steadier than these ups and downs we're seeing here, but a much lower return. The value of your return on the JSE, this is R1 invested in 1960 here, would be worth about 8,000 if you'd put it into the market. If you'd lent it to the government, there would be only 256 Rand sitting in your bond account. You don't need a t-test to see which was the better strategy. Now, how can we get rid of some of this risk? Here I'm just showing you monthly returns on the JSE, and you can see that there's some really big crashes at times. You'll also observe that risk seems to have got bigger over time. If you do this daily, using the same index over here, you can see I haven't changed the Y scale here. You can see that it's much less risky than it was with bonds. So one way of reducing risk is to put your money into bonds, but lower returns. So we also can measure risk in terms of what we call implied volatility. And the way we refer to this, this index, this is the VIX, sometimes referred to as the fear index. What it does to measure implied volatility is it looks at option prices. And to price an option, you need to estimate the future volatility of shares, or whatever the option is based on, actually. And so we can see times when the market is extremely anxious, and by stripping out the implied volatilities, we can observe just how nervous the cross-sectional volatility, in a sense, is amongst shareholders. And you will notice that the Lehman collapse here in 2008, the VIX peaked. And then there have been other issues that we've had to worry about and so on, which kind of put fear into the market. And when I drew this chart here, COVID-19 was sitting at quite a low level. But that was in the early days of COVID-19. If I update that chart now, you will observe here that COVID is at the highest level here, and it's actually higher than where we were with Lehman Brothers. So right now, VIX-mageddon, as Bloomberg called this, John Authers actually in Bloomberg called this, is something that we are very concerned about at the moment. Now, one thing we've known about for years is that if you were to plot the risk and return, so in fact the risk is on this axis over here, I should have labeled these, sorry, and the return is on this axis over here. So this is the return, I'm not sure if I can write here, RTN, and this is the standard deviation of the shares on this axis over here. You will see that, and this I'm looking at, in fact, actual data using the last 5 years of the StockX. This is the biggest 50 shares in the Europe stock market here. And for each particular share, you get a particular point, a particular risk, and a particular return. But if you had formed a portfolio, an equal weighted portfolio of those shares, you would have found this red point over here, and it sits to the left of this average risk here, and you do get the average return. It's actually the average of all of these points in terms of the y-axis, but it is not the average in terms of the x-axis. So you get a reduction in risk the minute you take a portfolio. Now, the reason for that, and I'm just showing you here, if you had randomly picked 20 shares, and I'm using the European stock market to do this here, you might have got these 20 shares here. And you can observe that if you know that some of these shares have got much more risk and not much return, actually, like this one over here, than others. But the important thing I want you to notice is the black dot here. The black dot is always going to be midway in terms of the return, because we're taking just the average return here, but it will be lower in terms of risk. That's just the way it is. And here's another portfolio. Again, look at the black dot. It's in the middle, but it is low in terms of risk over here. It's this side always. Here's another portfolio. You can see it's not always the lowest, but it is low in terms of risk, and it's the average return of that portfolio. So the reason for that is that if you take two shares, and here I'm taking SAB Miller, and down here you can't see it, but I'm actually plotting BP, because SAB Miller is very unconnected to oil prices over here. If you took a portfolio of these two shares and you put 50% of your money into SAB Miller and 50% into BP, you would find that you get the average return. So the return is going to be the average of that number and the average of this number here. That's going to put you somewhere here kind of thing. But the risk is way down here. It is, in fact, that point there that you're getting here. So you get the average return, but you get much less risk. So the less correlated the shares are, the lower the risk the more risk you can get rid of. And you can see here, I'm just showing you some different plots here. This is Old Mutual against British American Tobacco. This curve over here doesn't drop very much. It's pretty flat, in fact, over here. If you were to do this with Rio Tinto and British American Tobacco, you get a slightly bigger curve, and so on. So simply by buying a portfolio, you get what investors call, markets call this a free lunch. You really should just buy a portfolio of shares, even if you randomly select these shares. And here you can see they're talking about them throwing darts into the stock exchange page here, and how well did throwing darts do compared to professional analysts and so on. So you need to do that. You need to buy a portfolio of shares, not just a single one. Now let's just summarize some of the key points that we have seen. First of all, equity is more risky than debt. We know that, but it does produce higher returns, which is why it's attractive. The level of risk varies from time to time in the market. There are times like now when the market is very, very sensitive, very risky, and there are times when it feels stable. When it's risky, those create opportunities and problems for investors. Now, we can also see that you ought to focus on kind of longer term data. Don't sit there worrying about the short term cycles. Think long term. And finally, you can reduce risk, reduce volatility with a portfolio of shares. You should always make sure you hold a portfolio and you get the free reduction in risk. I hope you found that helpful.